if you've sold a property, shares, crypto, or any other asset that attracts capital gains tax, you can quickly realize you could be up for quite a large tax bill. Luckily, there are a few strategies that you can implement both before and after you've sold the asset that can dramatically reduce this bill. Let's start with talking about what happens before you sell the asset, and this is typically the most important time because when you have the most options that are available to you to reduce this bill. So first, you need to understand how does it actually work. So there is no separate capital gains tax as such in Australia. What happens is you will make a capital gain or a capital loss, and then this goes into your tax return. And if it is a capital gain, then you'll be taxed at your marginal tax rates, or if you're a company, at your company tax rate. So it'll just be lumped in with all the other tax you pay. It won't be separated as such. But you need to understand how does it actually work for capital assets, because there are a range of different concessions that you may be able to access that could reduce this. So the most common thing is the capital gains discount. So if you hold a capital asset for at least 12 months, then you will get a capital gains discount. So let's have a look over here to see how it actually works. So if you sell the asset and there's no contract to sell, the CGT event happens at the time of sale. If there is a contract to sell the asset, then the CGT event happens at the date of the contract. So a great example of this is property, that if you sell a property, it's going to go based on the contract date, not the settlement date. And then if we have a look here, if you have an asset that is lost or destroyed, the CGT event happens when you first receive an insurance payout for compensation, or if there's no insurance payment or compensation, when the loss occurred or when it was discovered. So you can see understanding the timing is really important, and unfortunately I've seen this go wrong where people have sold a property, for instance, thinking it is based on settlement dates, and it turns out it's on contract dates and they miss out on this CGT discount. So the discount is a 50% discount. So this means that your gain can be cut in half. And I think the best way to go through this is with an example. So say we've got some shares and we acquired them for $5,000. And now it is 10 months later and we want to sell them and they're currently worth $8,000. Now we're going to exclude all selling fees for now, and we're just going to work on this. So we sell that today and we've got a $3,000 gain. Now we aren't eligible for the discount because we haven't held them for 12 months. However, we want to compare and see what would happen if we hold them for 2 months longer, so we get to that 12-month mark. So we're going to assume that we're lucky that they're still worth the same $8,000 in 2 months' time, but now we can trigger that capital gains discount. So we still have made a $3,000 gain, but we now get to halve that gain. We get to apply that 50% discount, and now our gain that we're going to be taxed on is only $1,500. Now there are some other things that you need to make sure. It depends on if you've sold other assets, capital losses, etc. We're just isolating to this one particular sale. Now what we're going to do is work out how much tax difference this is. So we're going to assume we're on the 47% tax bracket. So in that first scenario, we have our $3,000 gain. We're going to pay 47% tax on it. So we're going to pay $1,410 in tax. Now in that second situation, we're going to pay half because we've only got a $1,500 taxable gain at the end, and the tax on that is going to be $705. So you can see we've halved our tax by holding for just 2 more months. Now the tricky part with this is, especially in volatile markets, look at crypto for instance, is it can be really hard to understand, is my asset still going to be worth the same amount of money in 2 months' time? Because there's no point saving tax if your asset plummets to nothing. So you do obviously need to understand that there's tax ramification, but you've also got general market implications of potentially waiting before you sell an asset. So something else that you want to understand before you sell your asset is, what is your income going to be in this year? Especially if you're talking large gains. Have you got other assets you're considering selling? Maybe you've got 2 investment properties and they both have a $100,000 gain each. Maybe you want to split those sales across 2 years. Doing some tax planning before you sell an asset is really vital because you haven't sold it yet, so you haven't recognized this gain, so you still have options available to you. So that moves well into our second category, and that is what happens after you've sold the asset. Is there anything you can do to reduce the tax then? Now, a lot of this is going to depend on, are you still in the same financial year? For instance, if you sell an asset in March, a lot of these strategies will need to happen before 30th of June to ensure that they actually save you some tax. So the first thing you want to do is consider, have I got other sales that I need to make that would impact this? And you may want to push them into a future year or bring them forward. It's going to depend if they're in a gain or loss position. Say you've sold a property and you've made a large capital gain. Well, do you now want to sell some assets? Maybe you've got some shares that are in a loss position that you can then offset this gain. And this is really important because capital losses can't be offset against regular income. They can only be offset against capital gains. For instance, if you've got a capital gain in this financial year and you've got something that you're going to sell as a loss, if you sell it now, great, you can offset that loss against that gain. But if you sell that loss position next year, you're going to pay tax on the capital gain this year, and you're going to be stuck with this loss in the next year that's just going to have to keep rolling forward. So this is something that you can work through with your accountant, for instance, do some tax planning and understand what is your current taxable position after the gain has happened, and is there anything else you can do with other capital assets to reduce that. When you're doing those calculations, you want to make sure that you've captured all of the cost base of that asset, so we make sure that we're reducing the gain through the legal methods we've got available, which are just claiming the cost. Now this might sound really simple and you go, well, what do you mean? So shares, for instance, when you sell those shares, you may have paid some brokerage fees. So that's going to reduce your capital proceeds. You may have also paid some brokerage when you purchase them. So that's going to increase your acquisition cost. So understanding that you've captured all the fees is really important. This is especially true for property, because property is likely going to have large fees on the buy and potentially on the sell as well. You could be paying stamp duty or some kind of mortgage fees. You also may be paying a commission to the agent when you sell, or some conveyancing fees. So there's lots of fees that go into selling a property, and you want to make sure you've captured all these so you're claiming all of these. With properties, you also want to understand, are there any capital assets that you haven't fully written off? Maybe you've put a new air conditioner into your investment property, so therefore you haven't claimed all the depreciation yet, and therefore you may be able to do that. Now there are some things that go the other way. Maybe you've been claiming capital works depreciation on your property, and this might be an add back that reduces the acquisition cost. So you need to understand what is going into your sale proceeds and your cost base to do these calculations, so you're making sure you're capturing everything that is vital to reducing that tax bill. Once you've done all this, you're going to have an understanding of how much tax you're going to owe, and then you can look at, are there any other aspects of your tax position that you could utilize in this financial year that could reduce it. Maybe you're looking at making some extra super contributions. This is one that quite often people do, is they sell a property, they make a large capital gain, and they put a chunk of that into their super to reduce this. Now, people think that this is linked. These are really just two independent things that are happening in your tax return, but obviously because they're happening in the same financial year, they're having an impact. But what is happening, you might have a $100,000 gain and you may be able to put a $100,000 concessional contribution, and these two things actually do offset each other overall, but it's not a direct correlation between those events. So what you need to understand is what else is happening in your financial year. Maybe you've got a business that's in a loss position. Maybe that is going to help reduce your overall taxable income. But a lot of these things are more just about understanding your overall tax position and how it impacts in a year where you've got a large gain. If this is something you are needing assistance with, my business Rushock Accounting can help you. We work with individuals and business taxpayers, and we deal with a lot of people that have complex capital gains positions, and we really want to make sure that you understand what your current tax impact is and what we could do to help reduce that. If you're interested, all the links to our business is in the description to this video. But for now, let's get back into the video and talk about the small business capital gains concessions that you could access. Now these ones are very complex, and you definitely need to seek that independent advice from your accountant to make sure you understand how they could impact you, because these can have impacts in the hundreds of thousands of dollars. So the first thing you need to understand is, are you eligible for these small business capital gains concessions? Let's have a look at some of the eligibility criteria here. So you must be one of the following: a CGT small business entity eligible with a aggregated turnover less than 2 million, or you need to be a partner in a partnership as a small business entity, and you need to meet the maximum net asset value test. The asset must be an active asset, and then there are more additional rules that apply if you are either selling shares in a company, or whether you're selling units in a trust, or if you're a partner in a partnership. So you need to go through step by step and look at all these eligibility criteria to make sure that you actually meet the eligibility. Once you've done that, there are 4 main concessions that you get to pick from. Now these are all independent from the 50% discount for holding for over 12 months, so you can still access that and then also apply these. So we have the 15-year exemption, we have the 50% active asset reduction, we have the small business retirement exemption, and the small business rollover. So what I'll do is I'll touch on each of them briefly, but definitely go and seek advice, look on the ATO website so you can understand them in more detail. So let's first talk about the 15-year exemption. If you meet the eligibility for this, and you've held this asset for over 15 years, you can completely disregard the capital gains. So you can see this could have a dramatic impact depending on how much gain you've made on the sale of your business asset. The next one is the 50% active asset reduction. So if you meet the eligibility of it being an active asset, you can further reduce the gain by 50%. So again, this can be used in conjunction with the 50% 12-month discount, so it could mean that your gain is already down to 25%. There is also the retirement exemption. So this allows you to access up to $500,000 across your lifetime of gains that can be accessed under the retirement exemption and exempt from CGT purposes. Now this one is a little bit complex, and it will depend on your age as to what you have to do with these funds, as whether they need to be moved into super or whether you can just hold on to them. And then there is the small business rollover. This one can be really complex, but could allow you to roll the gain into a new asset and then defer having to pay the tax on this one. I've had a few clients access this one recently. It's a bit complex to get right, but once you get it right, it can have a real major impact on your total tax position. Capital gains tax is just one area of tax. And if I could borrow just 5 more minutes of your time, in this upcoming video, I go through how to save taxes in just 5 minutes. I look forward to seeing you over there.